February 24th, 2025. Thank you so much for joining us. Today's Heavy Hitter Reports brought to you by the Trading Initiative. My name is Hamilton. I would love it if you liked and subscribed if you find this content valuable. We try to go live at least once per day going through different types of stocks and markets. And today's focus is specifically going to be on the strongest stocks in the U.S. domestic market. I know that's kind of an oxymoron right now, considering that the market has pulled back over the last two trading sessions, Friday particularly violent, but a lot of the damage that we saw in the market was kind of compartmentalized into the growth areas, right? We saw massive sell-offs in things like consumer discretionary and technology. Communications held up a little bit better. And thus, this morning, as we were going through our heavy hitters report, you can probably tell from the number of stocks on this list and their sectors and industries that the defensives held up relatively well last week. And as a matter of fact, a bunch of them are breaking out into new 52 and all-time highs, 52-week highs and all-time highs. So what I want to spend probably the next 15 minutes is not necessarily going through a bunch of trades that we're going to open, although that is valuable, and I think that there might be some on this list that are attractive. I think that it's more important to kind of talk through what this specific report is telling us from a positioning standpoint. Now, if you've been following any of our content over the last 2 weeks, 3 weeks, we've been talking a lot about this idea of sector rotation. Sectors have been rotating for this entire 2025 session so far. Back half of 2024, we saw a lot of weakness come into the market, specifically around defensive sectors. Lower volatility sectors really sold off. We're talking healthcare, materials, utilities, consumer staples. And then 2025 came in and we've seen the exact opposite. We've seen staples and energy perform the best. So the best two performing sectors year to date. We have healthcare up, materials up, industrials to a certain extent, right? They are doing a lot better than the growth areas of the market, the kind of offensive areas of the market, which would be something like a communications, a consumer discretionary, and a technology sector. So when we look at the strongest stocks in the S&P 500 right now that are U.S. domesticated stocks, right? We're looking at only U.S. companies, large caps and over, and we throw some technical filters on them. We look for certain volume requirements, optionable and shortable, et cetera, and then we kind of filter them by proximity to 52-week highs. So what we get here is a list of the strongest U.S. stocks in the market that are large cap or greater, right? And first thing that I noticed when we pulled up this report is there's a significant lack of offensive areas in the market, which makes sense. Over the last 2 weeks in particular, the market has really stuttered. And over the last two trading sessions, we've really pulled back. And a lot of those higher beta or growthier areas of the market have been hit harder than the lower volatility defensive areas of the market. So names like all of a sudden Philip Morris hitting 52-week highs. And as a matter of fact, a trade that we put on last year that worked a little later than what we would have expected up into all-time highs today. So Philip Morris, not something that we're going to want to open up here. Let's pull this back into the weekly. But these things, these range breakouts, the market all of a sudden is now rewarding them, right? So this is a very simple range, all-time high breakout at 123.5. I opened this in 2024. I closed it for essentially a break-even trade. I didn't think that it was going to continue to go up after it had broke back down below 123.5 and then post-earnings took off here. But this is really starting to tell you the type of market environment that we're trading in, at least in the first quarter of 2025. Philip Morris hitting 52-week highs, where we have a slew of large cap tech stocks hitting 52-week lows. In particular, we have Microsoft, which is kind of leading the drawdown in tech right now. I think it was down 2% earlier today, whereas we have Philip Morris up at 52-week highs. So once again, kind of talking through this type of positioning in the market is not conducive, at least yet, to higher beta or growthier areas of the market. The market is positioning themselves in more lower volatility defensive areas of the market. Big question here is, does that continue? Or is this kind of that seasonal February weakness that we've been seeing go around? You know, there's some interesting data out that when the market hits an all-time high, which even with a lot of the weakness in growthy areas of the market, higher beta areas of the market, we were just at all-time highs in the S&P 500 last week. When February sees an all-time high, you go all the way back to 1950, there's an 85% chance that the rest of the year closes green and it's double digits, meaning over 10%. So that's a stat that I don't want to necessarily lean on and say it has to happen, but that's a very interesting idea, because if you think about seasonality in particular and the type of stocks that we're seeing here on the Heavy Hitters Report, February is frequently one of the weakest months out of the year. Bank of America just released a chart that shows the first year of an election cycle. February is the worst month out of the year, down 1.6% on average. We still have a week to go in February, and we're actually up on the month in both major market indexes, at least we were earlier this morning. So do we see some continued breakdowns, and will that be led by higher beta areas of the market? It looks like it could, right? Defensives are posturing to be up. Problem here is, does that continue to roll into March, which seasonally begins to start to pick up for the bulls, right? March through June tends to be a pretty good corridor, particularly during the first year of an election cycle, tends to be relatively strong. So are these lower volatility defensive sectors, types of stocks being bought right now, are they going to continue to run over the next 6 months? It's hard to tell right now. But that's what we're seeing dominate the market. We have names like Philip Morris. We have names like AT&T. I mean, these are value all the way through and through, right? Dividends, everything else is going up. You have AT&T screaming to the upside here after bottoming out in early 2023, up and over its 200-day moving average on both a daily and a weekly. Not something we want to own here as of right now, but once again, showcasing the type of market that we're in. A tech name that we actually do like, and we did open up here, is ADP. So one thing that we like to do inside of TTI, particularly on down days, is we want to look for relative strength. Regardless of how you view the market right now, we are still trading north of an upward sloping 200-day moving average, and as annoying and choppy as the indexes are, we have not yet rolled over. We are not hitting new lower lows. So if you want to place your bets that that's the bull market top, feel free. I'm not in that camp. I would prefer to just be more cautious with my capital right now and wait for a firm resolution either to the upside or downside. But I'm still in the bull camp as long as we are trading north of an upward sloping 200-day moving average and we are not breaking into new lows. So on every day the market is pulling back, we're looking at relative strength, what stocks are bucking that trend, right? For whatever reason, ADP is not selling off with the broader market. And by the way, this is with a lot of tech weakness right now. Tech was down over 1% today. A lot of that was coming through because of Microsoft, but still ADP green on the day. So if you're looking at potentially owning a tech trade, ADP should be high on that list. Once again, for whatever reason, take this concept and run with it. The market is down today, but ADP is not, meaning the odds of ADP outperforming when the market, or if the market swings back to the upside, relatively high, right? So this is a trade that we opened up, I believe last week or 2 weeks ago, as it was breaking up and over the 310 area. We like this up towards 375. I think it's a fairly simple trade. I'm not saying it's easy or it's going to work, but it's fairly simple. We're trading north of an upward sloping 200-day moving average. We're within this beautiful bullish momentum regime. It's a little bit slower of a tech stock at 1.53 ADR, but it's a large cap, right? One of the largest tech companies in the United States right now, and once again, it's showing relative strength. So we like this above 310, up towards 375. Stop's got to be somewhere underneath $300. Sets up for a really nice R to R. And there's also a great options opportunity inside of TTI. The trade is already posted, so feel free to go and find that if you're not already in it. And if you want to take the trades with us, feel free to click the link in the description and figure out what we're about. And if it makes sense, feel free to sign up for a quarterly subscription. But ADP looks good. This is one of two tech stocks on this list that I actually really like as of right now that are hitting the list. One thing I want to point out here before we go through the rest of this is look at the significant lack of Mag 7 stocks. There's not a single Mag 7 stock on this list. I think this is the second time in the last year or 2 years that Mag 7 stocks have not hit this list. There is just a significant amount of weakness right now in Mag 7. I think last week Meta was on this list. So I think last week there was at least one Mag 7. Don't hold me to that. But it's not often that we don't see any Mag 7 on this list. It's just not common. But that's what we're seeing right now, and that really does go and tell you the type of market that we are currently trading in. It's just not a very conducive market right now to kind of the growthy areas of the market, the higher beta areas of the market. But here we have ADP. Let's keep going through this list really quick. There's a couple of them that are standing out, I should say, that you could potentially be throwing on watch list here. IBM, not a name that we own any of yet right now, but this is a potential COD setup. We're waiting for this to consolidate a little bit further, and then we could potentially grab this for a price target up towards 300 and a stop somewhere underneath 255 or 250. So a nice R to R setup there. IBM, once again, no idea why, but after it broke out in the late 2023, early 2024, it's ridden its 200-day moving average up and continues to surprise to the upside here. We see a bunch of financial related stocks as well. Now, we don't have any exposure in ICE or SPGI right now, but I do want to point out that it's not just financials that are breaking out in the United States. The European financials also closed at all-time highs on Friday. EUFN is the ticker there. All-time highs, European financials. So everyone's freaking out about how, Europe is done. They just had some sort of Germany election going on, and the guy that Twitter wanted to win didn't win, or whatever the party. Everybody says Germany's over, and yet Germany is continuing to close at all-time highs week over week. And so are European financials. Everybody's writing off Europe, and yet we're seeing those. Well, we're also still seeing it in the United States as well. Financials are not rolling over here yet. They don't look terrible yet. As a matter of fact, a lot of them look really, really good. And when or if the market does find a floor, we're going to want to go ahead and look for the relative strength leaders, right? ICE holding up very well. A lot of the larger bank stocks have pulled back slightly here. ICE has not. We like this on a continuation play above 170, 171 for a price target north of 200. We'll see if we get up there or not. And then once again, we have SPGI, which has been on the list for a long time. I'm going to go ahead and remove this. This is just constantly on the list. For whatever reason, above 475, this thing has not wanted to pull back underneath its 2021 highs, and that's what we like. Do you really think this market is going to roll over while SPGI is continuing to press up into all-time highs? You can make the argument all you want. I don't think so. This is a pretty important stock when it comes to investor sentiment and the way markets are currently being utilized by a majority of the population here. Riding north of an upward sloping 200-day moving average, RSI is above the 50. Not a great stock that I want to own right now, but a nice sentiment stock. Is the market going to roll over here as long as this is still breaking out? I'm not entirely sure about that. Could be wrong. We'll see. Berkshire up at all-time highs today. Shout out Warren Buffett. There's a lot of crap right now going around about how Warren Buffett has a record amount of capital or cash, right now on hand. And while that could be absolutely correct on an absolute basis, as a percentage basis, it's not correct. And as a matter of fact, Warren Buffett came out in his annual shareholder letter and basically said, listen, everybody's talking about how much cash we have on hand right now. I want you guys to know that the majority of the capital that we own is in equities, and that's not going to change anytime soon. So headlines going around everywhere. I mean, there's always a bias behind every headline that gets posted. Try to peel back and kind of find out the real story there. As of right now, at least right now, Mr. Warren Buffett is telling us not to worry too much about the capital on hand that he has. CME Group is another one that's been on the list a couple of weeks in a row here after breaking up and over its 2024, late 2024 highs here. CME pressing up in towards a potential 52-week high. Is this an all-time high as well? Yes, it is. So up and over 250 here. I think there's a clear line in the sand. I'm going to go ahead and remove that drawing. But up and over the 250 area, all-time highs here. CME, yet another look at kind of like the same type of idea as SPGI. If these are breaking out to all-time highs, is the market really going to roll over yet? I'm not entirely sure about that. We're going to go down the list here, and there's a bunch of financials that I really like. This is a name that we've owned at different periods of time. We liked this at 64.50. It worked really well for us up towards 82. We were able to open up a little bit more into 82. We're currently just slightly below all-time highs, but still continuing to press here. If we do get some sort of pullback to 82, I think there's an opportunity to own BK, Bank of New York Mellon Corporation, with a price target north of $100. That's what we're targeting there. Great opportunity for an options trade as well. This has open interest. This has volume. It's relatively low IV, so a great opportunity to own an options trade into an all-time high type of move. And those are the best types of trades that we like to take in bull markets whenever you can get outside of that overhead support, or overhead resistance, kind of that path of least resistance higher. You can marry that with lower implied volatility and buy some calls there. You can really lever up with a very small amount of capital risk. You can lever up there and hopefully make a bunch of money if these things continue to scream up, which typically they do. In bull markets, all-time highs generally beget new all-time highs. That's how uptrends work. And so we like BK there. Another trade that we opened up that actually turned free for a couple people on Friday, Starbucks here. We like Starbucks up and over 110. This was on the list last week as well. We like this up towards 135. Still think there's an opportunity to own this if it pulls back to the 110 area. If you want to try to buy some weakness here, once again, this is another one of those trades. It's pretty good from an option standpoint. Implied volatility is pretty low here, and you can own this thing up and over the 110 area into an all-time high move up towards 135. So once again, taking a relatively small amount of capital on a pullback and really throwing some or levering up there and throwing some bullish exposure into Starbucks, assuming that we bounce off the 110 area. We really like this play. So as of right now, a bunch of the people inside of TTI have a free ride in Starbucks, closing half at 100%. Now we have some free lotteries in through Q2 of 2025. We'll see if it bounces back up with the rest of the market. And then the last one I want to talk about is Cisco. So Cisco, there's not a lot of tech-related plays on this list right now. IBM, what was the other one that we were just going through? There was IBM, ADP, and we have Cisco, right? Cisco, we like this up and over $60. An old .com winner here. Potential pullback. I don't know if it'll pull all the way back to $60, but we opened it at $60. We're just going to sit here and kind of wait for it to float up towards that $77 price target here. This is decade highs, right? Cisco, who would have expected this to re-break out ever and potentially get even close to where it was during the dot-com bubble fiasco? But here we go, right? Cisco breaking back out. If we get a pull back to 60, do you want to try to open it? You can feel free to try to buy that dip down there as long as it holds 60, but I don't think it's going to pull all the way back. I think we're firmly up and over $60, and barring a bear market reversal here, which the indexes are very much shoving in the faces of everybody right now, I think Cisco has a path of least resistance higher up towards 77. But once again, take this report. You can follow me on Twitter at How to Swing Trade, and I post this stuff every single day, one report, every day more or less. And you can take this and kind of scan through these yourselves, find any types of setups that you like. The main thing I like about this particular report, though, once again, is the fact that it gives me a snapshot on what types of areas of the market are really working the best. What are the most prevalent, right? If you think about it from a strength standpoint, filtering things by proximity to 52-week highs and kind of looking at the top of that list there will give you an understanding of what types of sectors and industries are working on an absolute basis. We can see that, right? Healthcare probably doing okay if Abbott Laboratories is up there. Consumer staples probably doing okay if Philip Morris is up there, etc., right? And it just so happens that that's exactly what's going on. So if you can pinpoint these themes early, these sector rotations early, and you can match those with the leaders within those sectors and industries, and there's some sort of technical setup there, you can get ahead of these. And who knows? I mean, just take a look at Philip Morris again. If these things take off and really start running, you might be in a trade for the last month, 2 months, get it free. Then you'll have, 3 to 6 months worth of exposure free if you flip half at 100%. And who knows how far these things actually go, right? We don't like to time the absolute top on these things. We like to take risk off into uptrends. And if they want to keep going, great, they're going to continue to pay us. So that's what I got for you today, the Heavy Hitters Report. We're not going to be opening up anything here today off of the Heavy Hitters Report. I think today is more of a wait and see how the market shapes up. Once again, we want to get through the February seasonality. There's a lot of stuff going on in Europe and China right now from a risk standpoint, and it's taking away from some of the risk on sentiment in the United States. That doesn't necessarily mean that we are getting out of everything. It doesn't mean that we're shorting everything. Primary trends are still up. And until that changes, we're going to continue to look for stocks that are hitting new 52-week highs and or showing relative strength. So when the market does bounce, we can own those again. Okay? If you like this type of content, please like and subscribe. Leave a comment.